Huawei is currently testing its own LDP chip printing technology, equivalent to the EUV machines produced by ASML, marking a major leap in China's bid for semiconductor self-reliance. Could this shift alter the global balance of technological power? Huawei is experimenting with laser discharge plasma, or LDP, lithography systems at its facility in Dongguan, China. The machine emits 13.5 nanometer extreme ultraviolet light, similar to ASML's EUV systems, which cost around $200 million per unit. If successful, Huawei could bypass the West's technological dominance in advanced chip production. The development of LDP is seen as a strategic response to export bans imposed by the United States and its allies, bans that prevent ASML from supplying EUV tools to China. Given that China accounts for 36% of global chip consumption, mastering chip-making equipment internally would weaken those restrictions and let Chinese firms compete in the sub-7 nanometer market. This is not just a technical breakthrough, it could shift global supply chains. And if Chinese firms reach full independence, consumers in emerging markets could gain greater access to affordable, competitive devices. Following U.S. sanctions, Huawei and the Chinese government have invested over $193 billion in domestic semiconductor development. The goal, a fully self-sufficient supply chain, from research to chip fabrication, without relying on Western technology. Results are starting to show. SMIC, China's leading foundry, has already commercialized 7 nanometer chips without EUV tools. Huawei's Mate 60 Pro, powered by the Kirin 9000S chip, delivers full 5G capability despite export bans. In AI, Huawei is developing the Ascend 910D chip to challenge NVIDIA's high-end offerings, and a pilot LDP production line is set to launch by 2026. Sanctions have become a catalyst, pushing China toward domestic innovation. In the long run, that means more next-gen tech at lower prices, especially for consumers across Asia and Africa. Huawei's Harmony OS now holds a 19% market share in China, powering over 900 million active devices. Its App Gallery platform has 580 million monthly users and offers developers a 15% commission rate. Huawei Cloud, Pedal Search, and IoT devices are growing fast, especially across Southeast Asia and Africa, challenging the dominance of Android and iOS. This growth brings users more choice and fuels competition and innovation across the tech industry. If Huawei commercializes LDP, it could break ASML's monopoly on EUV machines. This would allow chip making under 5 nanometers for use in AI, defense, and autonomous vehicles without relying on any Western parts. Industry experts warn that if Huawei exports LDP to developing nations, U.S. controls could be sidestepped entirely. At that point, this is no longer just about technology. It becomes a strategic showdown with global consequences for the entire semiconductor industry. A Chinese EV maker is rewriting the rulebook on price and performance with one tiny car. Can an electric vehicle really cost less than a smartphone? The BYD Seagull is making headlines worldwide as possibly the most affordable electric car on the planet. This compact urban EV, classified as an A-segment model, has a starting price of just 56,800 yuan in China, roughly $7,800. While earlier social media buzz claimed a jaw-dropping price tag of $4,999, the official base price still positions it as one of the cheapest electric vehicles currently available. Built with BYD's signature Blade LFP battery technology, the Seagull offers 2 battery options, 30.08 kilowatt-hours and 38.88 kilowatt-hours. This translates to an impressive range of 305 to 405 kilometers, based on China's CLTC standards. For American consumers, the Seagull represents what could be a disruptive force in the EV space. If a similarly priced vehicle were introduced in the US, it could dramatically increase EV adoption among cost-conscious drivers, lower the entry barrier for electric mobility, and pressure domestic manufacturers to innovate faster while reducing prices. The big question is, can the US match this level of affordability without compromising safety or performance? In April 2025, BYD officially overtook Tesla in battery electric vehicle registrations across Europe for the first time. The Chinese automaker logged 7,231 fully electric vehicle registrations, narrowly edging out Tesla's 7,165 units. This marks a 395% year-over-year increase for BYD, driven by aggressive pricing, technological advancement, and a broad range of models catering to diverse consumer needs. Tesla, on the other hand, experienced a steep 49% drop in European sales. Analysts point to growing competition, economic pressures, and negative public reaction to controversial statements from CEO Elon Musk as key contributors to this decline. This shift signals a rapidly changing dynamic in the global EV market. For US consumers and automakers, the message is clear: competition is no longer just local. BYD's rise in Europe suggests that Chinese EVs may soon challenge Tesla's dominance in other markets, potentially including North America. The US industry may need to brace for a new era of pricing, performance, and public perception battles. In May 2025, BYD introduced the Seagull to European markets under the name Dolphin Surf. The rebranded model includes modifications tailored to European regulations and consumer expectations. Enhancements include a slightly larger body, upgraded powertrains, and battery options ranging from 30 kilowatt-hours to 43.2 kilowatt-hours. The Dolphin Surf offers a range of 220 to 310 kilometers under the WLTP standard. With a starting price of €22,990, approximately $26,000, it remains significantly cheaper than most EVs currently sold in Europe, including Tesla's entry-level models. Although the price in Europe is more than triple that of the Chinese version, Dolphin Surf still undercuts many competitors. If this model succeeds, it could encourage similar offerings in the US, especially in urban markets where compact low-cost EVs are in demand. It also raises concerns about how US automakers will respond to rising pressure from Chinese imports if trade barriers loosen or consumer interest grows. Although the United States and China have agreed to a 90-day suspension of tariffs, American consumers have yet to see any relief in prices. Why are goods still expensive, supply chains congested, and businesses under strain, even when the trade war appears to have cooled down? Despite a 90-day trade truce and a reduction in import tariffs from 145% to 30%, the current rate remains several times higher than pre-conflict levels. Before the suspension, orders from China to the US dropped by 30 to 50% due to rising costs and container shortages. In April alone, shipping volumes between the two countries declined by 30 to 40%, and this trend has yet to reverse in May. According to multiple economists, even with tensions easing, each American household is still absorbing nearly $4,000 annually in added costs from higher goods prices. This stems from a cascading effect: businesses cutting back imports, product shortages emerging, and ultimately elevated consumer prices at supermarkets and retail outlets. The impact of tariffs goes beyond trade, severely disrupting the logistics sector. About 20% of shipping routes from Asia to the US West Coast have been canceled, and 18% of East Coast routes are also affected. FreightWaves reports a nationwide import decline of approximately 25%, along with a 5% drop in domestic trucking volumes. Within an industry worth nearly $1 trillion, container shortages, truck delays, and port congestion have caused widespread shipment bottlenecks. The resulting spike in transportation costs has pushed up prices on food, electronics, and construction materials. Small businesses lacking supply flexibility are especially vulnerable to cost hikes. Many have resorted to layoffs or suspended operations, directly impacting American workers and consumers alike. In June 2025, cargo volume through Southern California ports, main entry points for Chinese goods, plunged by 35%. Essential goods such as leather, textiles, chemicals, building materials, and processed foods have been directly affected by supply shortages. Small businesses are bearing the brunt. Without the capital to stockpile inventory or absorb logistics inflation, many startups and local retailers have been forced to shut down. Workforce reductions have begun across several industries, jeopardizing the incomes of millions of American families. Meanwhile, consumers are paying higher prices for basic goods, from home repair supplies to daily essentials. A convergence of rising prices, disrupted supply chains, and increasing unemployment is placing the economy on unstable footing, with economists warning of an imminent recession in the second half of the year. Unlike the first term, the Trump administration's new tariffs were implemented within 1 week, with no warning, no schedule, and no exemptions. Businesses had no time to prepare and were forced to respond reactively. According to the Institute for Tax and Economic Policy, most experts had anticipated tariffs to range from 10 to 35%. Only one analyst projected rates above 50%, yet the reality reached as high as 145%. This surprise disrupted manufacturing and import systems nationwide. Many firms have tried to redirect orders to Central America or West Africa to reduce dependence on China, but these regions lack the infrastructure to serve as viable alternatives. In the short term, production costs have surged, especially in sectors with thin profit margins. As a result, major retailers like Target and Walmart have slashed advertising budgets, laid off staff, and reduced inventory orders. This has impacted tens of thousands of workers and left store shelves sparse in many communities, limiting access to essential goods, particularly for low-income households. The United States and China have reached a surprising 90-day tariff truce, temporarily cooling a years-long trade standoff. But will this short window bring real relief or just delay deeper trouble? Starting May 13, 2025, the U.S. and China have entered a 90-day trade reprieve. Washington has slashed import tariffs on Chinese goods from a staggering 145% down to 30%. In return, Beijing lowered its tariffs on American products from 125% down to just 10%. This sudden shift is part of a provisional agreement, giving both sides a limited period to negotiate a long-term trade framework. Despite the cuts, the new U.S. tariff level of 30% remains steep. It's still far above pre-trade war levels, about 20% under the Trump era in 2018, and vastly higher than the global import average of just 3%. Analysts are calling this a pause in hostilities, not a peace deal. For American consumers and importers, the reduction offers some breathing room. Electronics, clothing, and machinery are likely to become slightly more affordable. However, uncertainty looms. Many fear that after 90 days, tariffs could snap back to punishing highs. Retailers and manufacturers remain cautious, hesitating to commit to bulk orders that may arrive too late. Small business owners say they feel caught in limbo, unsure whether to invest or wait. Some large retailers are preparing limited time sales, but warn that prices may climb again after August if no deal is reached. At key U.S. ports, especially Los Angeles, the damage from high tariffs has already taken its toll. Cargo volume dropped 35% compared to the same period last year. Importers had halted shipments for weeks, unable to absorb 145% duties. The port saw a sharp decline in arriving vessels, leading to hundreds of daily layoffs among dock workers. Even with tariffs reduced, recovery won't be immediate. A flood of delayed shipments is expected between late June and early July as businesses rush to capitalize on the 90-day window. But ports are under strain, equipment has been idle for weeks, staffing is short, and logistics systems are out of sync. Consumers may still face delays and limited product availability through mid-summer. Local communities near ports report rising unemployment and food bank demand. Labor unions are urging for emergency support to get workers back in systems running before the shipping surge hits. Despite the tariff relief, many U.S. small and mid-sized businesses remain hesitant. The 30% import tax is still a heavy burden, especially for industries like apparel, electronics, and medical supplies. Many fear the window could close suddenly if tariffs spike again mid-shipment. Companies could be saddled with unsellable, overpriced inventory. As retailers play it safe, inventory levels are dropping fast. National chains report just 5 to 7 weeks of stock left for key seasonal items, including summer fashion and school supplies. Some businesses are narrowing their import selection, prioritizing high-margin goods over variety. Shoppers may soon notice fewer choices and higher prices on store shelves. Economists warn this may hit low-income families the hardest, as they rely on budget-friendly seasonal deals. Parents may face back-to-school shopping shortages unless supply chains stabilize soon. A statement by U.S. Vice President J.D. Vance has triggered a new trade crisis with China, plunging numerous businesses into chaos. Could these growing tensions lead to a full-scale trade war? In mid-May 2025, Vice President J.D. Vance referred to Chinese workers as peasants during a public speech, prompting a fierce backlash from Beijing. China immediately imposed a 125% tariff on U.S. goods without warning or negotiation. The comment was seen as a serious insult and was swiftly leveraged by Chinese media to stoke nationalist sentiment and call for a boycott of American products. U.S. businesses came under intense pressure as the new tariffs made their exports to China significantly more expensive and less competitive. Beijing's retaliatory action not only escalated tensions, it also left many American firms vulnerable. Domestically, consumers now face the prospect of higher prices if tensions persist. Following the tariffs, a widespread boycott of U.S. luxury goods erupted across China. Chinese consumers turned away from brands like Apple, Nike, Coach, Louis Vuitton, and Gucci. Many retail outlets became deserted, described as post-apocalyptic showrooms. Kering, the parent of Gucci, lost over 30% of its stock value in Q1. LVMH, the owner of Louis Vuitton, saw shares drop another 2% overnight. This downturn is more than just financial. It reflects how geopolitical tensions are now reshaping consumer behavior globally. The trade war fallout is clear in aviation and logistics. China canceled an order of 20 Boeing aircraft worth an estimated $400 million. Boeing's CEO confirmed that deliveries have been halted, putting hundreds of engineering jobs at risk. Hong Kong, a key Asian shipping hub, suspended freight to the U.S., leading to severe supply chain disruptions. Shipments are stalled at ports. Customs systems are overwhelmed. Delivery times have stretched from days to weeks. American consumers are feeling the impact: delayed orders, out-of-stock products, shortages in electronics, medical gear, and tech accessories. Though both sides have reduced tariffs from 145 to 30% for the U.S. and from 125 to 10% for China, analysts say the damage is done. Global confidence in U.S. trade policy has been shaken. Canada and the United Kingdom are now reassessing trade agreements with the U.S. India has declined to offer new tariff concessions. Longtime partners are moving to reduce dependence on the American market. And consumers? They're feeling the pressure. Food, medicine, and electronics are getting pricier. Products are vanishing from shelves. choices are shrinking. Household purchasing power is in steep decline. A recent survey shows over 60% of Americans believe current tariff policies are doing more harm than good to the U.S. economy. As new tariffs take effect, American businesses are facing mounting cost pressures. Could current trade policies push the U.S. economy toward a new crisis? Jamie Dimon, CEO of J.P. Morgan Chase, has warned that new tariffs are steering the U.S. economy toward a period of stagflation, high inflation paired with slow growth. He believes financial markets remain complacent and have yet to fully price in the impact of tariffs that could reach 145% on Chinese imports. Dimon also noted many trade partners are turning away from the U.S., instead signing agreements elsewhere, weakening American exports. A survey by Allianz found that 68% of global exporters are actively working to reduce exposure to the U.S. market due to the unpredictability of its trade policies. For American consumers, the consequences are already taking shape: higher interest rates on mortgages, car loans, and credit cards, while real income declines, placing further strain on everyday living expenses. Under pressure from the new tariffs, companies like Subaru and Walmart have confirmed price increases. Meanwhile, Home Depot is holding prices steady on select items, but eliminating lower-margin products, gradually pushing affordable goods off the shelves. Notably, the sub-$25,000 vehicle segment, once popular with middle-income consumers, is disappearing. As the 25% import tariff eliminates profit margins in that category, for consumers, this means higher prices and fewer choices, especially in rural and suburban areas, where incomes are modest and alternatives are limited. Many small businesses are being heavily impacted by tariffs ranging from 30 to 145%. Beth Benieke, CEO of baby product company Busy Baby, was forced to launch a crowdfunding campaign just to cover $48,000 in unexpected tariffs on imported goods from China. But beyond the cost, the greater challenge lies in the instability of the policy environment. Constant shifts in tariff rates make production planning nearly impossible, leading to supply chain delays at ports and factories. This not only undermines the competitiveness of small firms, but also threatens jobs and the diversity of products available to consumers. Some officials in the Trump administration have admitted that unpredictability is being used as a negotiating strategy to gain leverage with trade partners. However, this approach is paralyzing global supply chains. As businesses cannot predict what changes may come from week to week, in response, the Small Business Liberation Act, a bill proposing tariff exemptions for small businesses, is under discussion, though its passage remains uncertain. For small and medium-sized businesses, this uncertainty is discouraging investment, delaying procurement, and increasing financial risk. Ultimately, these effects ripple through the economy, raising prices, disrupting inventories, and affecting the everyday shopping experience for millions of Americans.
After months of heightened tensions, the United States and China have signed a temporary trade agreement aimed at easing pressure on global markets. Can this short-term concession bring lasting stability? On May 12, 2025, the United States and China officially reached a temporary trade agreement, effective for 90 days. Under the deal, the U.S. agreed to reduce tariffs on Chinese imports from 145% to 30%, while China lowered tariffs on U.S. goods from 125% to 10%. The move is intended to de-escalate ongoing trade tensions between the world's two largest economies and lay the groundwork for broader negotiations in the months ahead. Markets reacted positively to the news. The S&P 500 rose 3.3%. The Nasdaq climbed 4.4%. and the Dow Jones jumped 2.8%, its strongest one-day gain since March 2025. For American consumers, the tariff reduction could lead to lower prices on electronics, clothing, appliances, and other goods heavily reliant on Chinese supply chains. A welcome development amid rising living costs. However, analysts caution that the deal is only a short-term measure, and uncertainty remains, especially if future talks fail to produce lasting outcomes. As a result, both consumers and businesses in the U.S. are likely to remain cautious with spending and investment decisions. While Washington and Beijing reached a temporary agreement, several close U.S. allies expressed concern and disappointment over the current trade policy. Japan, South Korea, Taiwan, and EU member states continue to face high U.S. import tariffs, ranging from 20% to 32%. These long-standing strategic partners feel sidelined, especially as the U.S. temporarily eases pressure on China, a country they still view as a major economic and technological rival. The situation poses growing challenges for businesses in Japan, South Korea, and Europe, which rely heavily on the U.S. market for exports of automobiles, electronics, and high-end consumer goods. For consumers in these countries, the cost of American imports may rise. While domestic industries face difficulties accessing the U.S. market, impacting jobs and economic growth, meanwhile, China may seek to exploit these divisions by expanding its influence through new bilateral or regional trade agreements. Following the announcement of the temporary trade deal, global financial markets experienced sharp movements. In addition to gains in U.S. stock indexes like the S&P 500, NASDAQ, and Dow Jones, 10-year government bond yields rose significantly across major economies. German bond yields climbed to 2.61%, their highest level since October 2023. Japanese bond yields surged to 1.48%, marking a 15-year high. These shifts reflect investor reassessments of risk amid rapidly changing global trade policies. For consumers and savers, higher bond yields could lead to increased borrowing costs, particularly for home, auto, and business loans. In Japan, the yen weakened to 145.62 per US dollar after the deal, a move that may support exports, but also raises the cost of imports, potentially fueling domestic inflation. This puts pressure on household spending, especially among seniors and those living on fixed incomes.
U.S.-China trade negotiations have once again stalled. Both sides failed to reach common ground on tariffs and intellectual property issues. Will American consumers continue to face an unprecedented surge in prices? Recent high-level trade talks between the United States and China have failed to produce any significant breakthrough. Disagreements persist over industrial subsidies and intellectual property protections. The U.S. continues to impose tariffs of up to 25% on more than $370 billion worth of Chinese goods, according to the Office of the U.S. Trade Representative in 2024. The U.S. trade deficit with China remained high at $279 billion in 2023, though down from the record $382 billion in 2022. This ongoing situation underscores the lack of a clear resolution to the trade tensions between the world's two largest economies. Maintaining high tariffs may drive up the cost of imported goods, directly impacting the cost of living for American consumers, especially for essential everyday products. In response to U.S. tariff pressures, China has quickly adjusted its trade strategy to reduce dependence on the U.S. and the U.S. dollar. Chinese exports to ASEAN reached a record $82.68 billion. In February 2023 alone, ASEAN has now become China's largest export market, surpassing the U.S. At the same time, the share of trade between China and Russia conducted in Chinese yuan exceeded 90% by the end of 2023, significantly reducing the role of the US dollar in bilateral trade. Although Chinese exports to the US fell by nearly 18% in 2023, China's total export volume still rose to $3.41